Hello and welcome to this Thursday, February 15th, 2024 edition of Your Daily Five. I'm Tom Bowley, Chief Market Strategist at EarningsBeats, and I'll be hosting this episode here for the next 15 or 20 minutes or so. And I thought I'd maybe take a little bit of a different approach. Every quarter, we put together a portfolio of, well, three different portfolios of stocks. We do a model portfolio, aggressive portfolio, and income portfolio. And I like to refer to it as our draft because literally we have thousands of companies that we can decide which we feel are the best for the next 90 days to put into our portfolio. So I just wanted to spend some time today maybe going through a little bit of that process with you. So let me pull up my chart here and we'll get this thing started. Okay. You should see on your screen EarningsBeats.com. This is my home. This is where I live on the internet. If you scroll down after going to EarningsBeats.com, you'll see a couple of things. First, we have a free PDF that you're more than welcome to come on and download. It's a free report that just talks about the S&P 500 and how it's performed over the years. Gives you a lot of historical perspective, which I think can help in your trading. So make sure you take advantage of that. We also have a free newsletter, our EarningsBeats Digest, which you can see right here. Name and email address is all it takes, and you'll be set there. And then finally, you'll see this history of success. This is where I do the model portfolio and the two others and continue to show our results. So if you click on this historical performance link, it'll bring up a page and it'll show you where we stand. Now, this quarter actually ends on February 19th. And of course, February 19th is Monday, which is a holiday. So it'll close out as of February 16th. We're probably going to actually close it out one day early and close it out as of today's close. But I want to just point out the results that we've had. And essentially, our strategy is just to put our portfolios in a position to outperform the S&P 500. And that generally requires leading stocks and leading industry groups. So if you take a look at our model portfolio this quarter, now keep in mind, this is not a calendar quarter. This is actually 90-day period that will end on February 19th. As I mentioned, it started back on November 20th. So each quarter is not exactly on that calendar quarter basis. So the next quarter will run from essentially February 19th to May 19th and so forth. But you can see this quarter, our model portfolio more than doubling the S&P 500. That has been our history since inception on our flagship portfolio, where we have gone up about 2.1 or 2.2 times the S&P 500 since 2018. So that was back in November of 2018 when we started this. And in the last quarter, again, we did have more than a double. And the draft will be coming up next Tuesday. And if you'd like to be part of that draft to see what stocks we put in each of our portfolios, you just need to be a trial member. So if we go back to the home page, you can see here there's actually a link where you can start a no-cost trial. That does actually require a credit card, so we can get you set up in our system. But that also will bring you in for our portfolio draft, which again will be held on Tuesday, February 20th, and that will be at 5:30 p.m. Eastern Standard Time. All right, so I want to go over some things that I think about going into these portfolios, because when you're putting together a portfolio, yeah, it'd be great. Just go ahead and pick up some NVIDIA, maybe pick up Apple and Microsoft and some of the big names, Amazon or whatever. But there's a lot of other companies under the radar that maybe you don't know of that also perform extremely well and can lead not only their industry group, but also outperform the S&P 500 by a wide margin. So it's our job to kind of look through a ton of earnings reports and try to identify some of these stocks that could help our portfolio performance as we move forward. So I want to go through and just show you a handful of charts here that I think will help maybe explain a little bit about what we do in putting together these portfolios. So one thing I want to do is I want to try to figure out the theme. Bottom line, first step is, do I believe the market's going up or down over the next 90 days? Not this week, next week, over the next 90 days. Where are we going to be in 90 days? Do I think it's going to be higher? Do I think it's going to be lower? And I look at a lot of my signals to try and help me make that determination. But let me walk you through a couple of things here first, because in order to pick leading stocks and leading industry groups, first thing you need to know is what are the leading industry groups. So I pulled up the S&P 500 here just to show you how the S&P 500 has been performing. But then at the bottom, I'm showing 5 industry groups that have performed extremely well over the past 3 months. These are the top 5 industry groups over the last 3 months. So here you can see the S&P's had a nice run, probably up about 10% or so. Here are 5 industry groups, though, that have done much better than the S&P 500. First, semiconductors. We're probably all aware of that. Semiconductors have made this huge run. You can see from 3 months ago, we were below 10.5. Now we're above 13.5. So it's actually been probably a 30% move, or even maybe a little bit more on the semiconductors, which is 20 percentage points above that S&P 500 move. Travel and tourism. Starting 3 months ago, you can see actually a breakout above the 875 area. And since then, this group really hasn't looked back, going from 875 up today to 1118 at this point. So it's been another really strong push to the upside. Asset managers, moving over to the financial area. Asset managers have been extremely strong, continuing to push higher. And this is one that certainly could continue to benefit, especially if rates come down later in 2024. Furnishings. So you got your furnishings. You can see this was a group that was really not performing well at all 3 months ago, in a steady downtrend. Even though the overall market had begun to trek higher, we really hadn't seen much strength yet in furnishings. But check this out. Huge rally and then sideways consolidation. So we have a nice little bullish continuation pattern. Nice move to the upside, and then sideways consolidation. A breakout above 365 would not only clear the highs here, but also would go back and clear the high that we saw several months ago. Finally, we've got industrial suppliers, and the DJUSDS, you can see also, after making this quadruple top breakout or whatever, however many tops you see there, after making that breakout, you can see it's been a very strong 3-month run here. So going into the draft, I know these are the 3 best performing groups right now. Something I would do is maybe look at a long-term chart, because some of these industry groups tend to lead for 3 months and then lag. So you can't really put a lot of confidence in it. But other groups tend to lead for a lengthy period of time. Certainly semiconductors are one of those. So this is a group that we certainly want to at least be considering for our next portfolio. Next chart I wanted to show you is another chart, S&P 500, same thing, 1 year. But here I'm showing you the groups that have been the best performers over the last week or so. And so we're looking at renewable energy. You can see paper making a big push to the upside. We've got airlines breaking out, at least above the most recent highs, this triple top. We've got industrial suppliers also making a big move to the, or not industrial, diversified industrials, I'm sorry. Diversified industrials making the break above 670 to a new high. And then finally, we've got waste and disposal services. Some of these groups had been leading previously, as you can see, others not. Paper had been going down, all of a sudden starting to show strength. Renewable energy going down, all of a sudden starting to show strength. So this is going to be another evaluation. Are these areas, these industry groups that are starting to show strength? Should I maybe be looking at some of these areas in putting together stocks in our portfolio? And trust me, this is just the start of trying to figure out the theme and what's going on in the market. But it is kind of the start. You have to know what's leading, then kind of go from there and decide, are the odds high that relative strength is going to continue? That'll be part of the challenge over the next several days. Next chart I wanted to show you, again, S&P 500, but I want you to scroll down here and I want you to look at some of the key ratios that I follow. The QQQ versus a spider. All of these ratios are set up growth versus value. So QQQ growth S&P 500 or SPY value. Now you might say, well, wait a minute. Spider has growth stocks, and it does. QQQ is the ETF that tracks the Nasdaq 100. Nasdaq 100 is almost all high octane growth companies. You look at the Spider, the S&P 500, you've got 500 different companies. You've got, yeah, some of the top ones, Microsoft and Apple and so forth, they're more growth oriented, but you've got more representation in the S&P 500 of value. So I like to look at the relationship, the ratio, to see, is growth in favor or is it value? Well, I mean, we've been continually moving up for the last year. So I'd say at this point, growth continues to be in favor, although that could be changing, and I'll talk to you about that in just a bit. XLY versus XLP. Overall, the chart trend continues to go higher. We keep printing higher highs and higher lows. We're not at the high right now. We did set a high that was back a couple months ago, but we have been trending up here in the month of February, and the overall pattern has been to the upside. You look at the IWF versus the IWD. This is large cap growth versus large cap value, breaking out, continuing to set new highs. Looks good. Transports versus utilities. If the economy is going to be strong or strengthening later in the year, you would be wanting to buy transports, and you probably would want to be out of utilities. Utilities being much more defensive. Transports not really being aggressive, but simply going along for the ride. If the economy is strong, transports normally do well and outperform utilities. And so all four of these ratios, maybe to differing degrees, but all four of these ratios continue to put in higher highs and higher lows, which tells me that the market remains risk on. So if we were expecting some kind of big move to the downside, I'm not talking about a pullback. I'm talking about at least a 10% correction or even a 20% cyclical bear market. Or there may be some of you think, hey, we're going to have a massive secular bear market. That's fine. Everybody can have their own opinion. But if you're thinking bad things down the road, I would just ask that you stop and consider why Wall Street is still putting their money into growth over value. It makes no sense whatsoever if you believe the economy is going to deteriorate down the road. We should be seeing these different ratios rolling over and printing significant highs and starting to break down. And we really haven't seen that yet. Next chart I have for you. This is a chart of the S&P 500. This is a different one. This is a little bigger picture. I wanted to just show you the 15-year channel that we have been in on the S&P 500. And when I draw channels, what I like to do is I like to take the panicked lows and draw a line and connect them. There's your lower channel line. Then I take that line and I drag it, and I try to connect the highs as best I can to just kind of give us the flavor of the channel. This 15-year, well, I don't consider it a secular bull market until we take out these highs, which we did in 2013. Some look back and say, well, the secular bull market began in 2009. And with hindsight, yes, it did. But you don't know if you're going to clear these tops when you're at the bottom. So you don't really break out and confirm it until you get above those prior peaks. Just to give you an example, why are we not calling this the start of the secular bull market? Well, because it never broke out, or not a meaningful breakout anyway. And then we ended up going right back down again. Well, if you're not going to count that, why are you going to count this one from the bottom? Shouldn't be really until you break out. So in 2013, I consider this right now about 11-year secular bull market. Some would look back and argue and say 15. Either way, whatever your fancy, it's fine with me. But by taking this same sloped line and moving up here, you can see that it lines up with a lot of tops. And occasionally we'll get a little bit of an overshoot like we did in 2021, right before a cyclical bear market. We also had this overshoot at the beginning of 2015, right before, wasn't a cyclical bear market, but that was a pretty tough time in the market for about a year. Early 2015 to early 2016 looked like we were rolling over, breaking out. But in both cases, we kind of came back to this middle line. This is the light blue dotted line that I'm showing here. And notice how many times we pull back and we hold that line and stay in the upper half of the channel. Here, obviously the low, financial crisis low, the pandemic low, and even the cyclical bear market low. We went a little bit below the center line. Also cyclical bear market here, slightly below the center line. But all in all, this remains in an uptrend. I think you would probably agree. If you look, just made another breakout. We're still holding this center line. We're not close to the upper line, by the way. A lot of folks saying we've just gone too far in this rally. Based on history, we haven't. Based on history, we will go right back up, test this trend line. We haven't gotten there yet. In fact, I don't know exactly where it would be, but I'd probably argue it's probably 500 points above where we are right now. So I think there's plenty of room to the upside based on this longer term secular bull market channel that we're looking at. The fifth chart I want to show you is the Nasdaq 100. Now this goes back 25 years, but again, just want to show you the channel that the Nasdaq 100 has been in. If you connect the 2009 low and you connect the 2020 pandemic low, and then the recent cyclical bear market low in 2022, you have a perfect trend line. If I grab that and I drag it up to connect the highs, I basically connect the highs except for 2021 when we got too far. That was one of the reasons why I talked about a cyclical bear market. That was, I didn't say it was guaranteed, but I said certainly there's a risk. There's an increased likelihood that we could see a lot of weakness in 2022. This was one reason. We're outside the channel. We had gone up 115% in 22 months on the S&P 500. I didn't even calculate it on NASDAQ 100. Maybe it's a lot more than that, probably is. But it was just too much in too short a time frame. So we needed that pullback. We got it. And now, again, just barely above the center line. Everybody talking about, oh, we've gone too far. We've gone too far. That's because we've come out of a bear market. The biggest gains, in my opinion, have been made. But I don't think we're anywhere near close to all of the gains being made in this secular bull market. And down at the bottom here, I have a rate of change, 12-month, 24-month, and 60-month. Just so you can see, and I've gone back 25 years, so you can see where we were at the dot-com bubble peak. This is 2000. So we had gone up, in 1 year, we had gone up close to probably over 50% at the peak, or at beginning of 2000. In 24 months, if you look in the first quarter of 2000, that look back for 2 years was somewhere around 90%. Pretty high. And then if you look back 5 years, you can see that that peak actually was up probably at around 160 or 170%. That's how much we had gained in the previous 5 years to where we were when the dot-com bubble ended. Look at where we are now. 11% over the last year, 14% over the last 2 years, and 61% over the last 5 years. That's an average of 12% a year. The historical average for the Nasdaq is about, well, it's over 10%. The historical average for the S&P 500 is 9%. So explain to me how we've gone up so much and why this market is so overvalued. I don't believe it is at all. All right, final chart, little bonus chart. We could be seeing a little crack in the foundation. Here's the S&P, but this is a 10-minute chart over the last 20 days. So almost a full month, back to January 19th. And you can see the S&P kind of going up. Look at the QQQ. QQQ actually topped back in, or back January 24th, relative to the S&P. And if you look at the XLY XLP, we topped about 3 days ago, 4 days ago on the IWF IWD, and 5 days ago on the transports versus utilities. And this vertical red dotted line right here comes in right at the S&P 500 high. And notice all of these ratios started to roll over before we got to the peak. So short term, I'm a little concerned about what's going on, which is why I think we could see more potential selling over the course of the next 2 to 4 weeks, maybe a little bit longer, balance of February and into March. I don't rule out moving to a new high. We're in a secular bull market. I think anything goes. to the upside. But we're certainly overdue for a correction, or not a full correction, but a pullback. Maybe this is the start of it. So I'm going to be following this rest of today, tomorrow, and into early next week when we decide what we want to do with the draft. Because if we are seeing these growth versus value ratios begin to roll over, that could make it difficult for these portfolios for the next 2 to 4 weeks, maybe up to a month. So anyway, those are some of the things I'm looking at. Obviously, I would be looking at individual stocks to see which ones are leaders and which ones make sense. And I'll be trying to weight the portfolios appropriately based on which sectors I want to have represented, which ones I may want to avoid altogether. And all of that comes on Tuesday at 5:30. So if you'd like to be there for that, make sure you start your no-cost 30-day trial, and you can get that over at EarningsBeats.com. Anyway, it's always a pleasure to join you for the Your Daily 5 episodes. Again, I'm Tom Bowley, Chief Market Strategist at EarningsBeats, and I want to wish everybody a great day. Happy trading.